Now, as we shift to the Asian markets, this kind of ties back to what we were talking about with in segment one when we were looking at what is inflation doing in some of these emerging markets. And now let's just focus in on Asia for a minute, where obviously there's a lot of crossover in terms of the difference between PPI and CPI and the gap. And this is one of the key pieces where when you look at PPI so much higher and that CPI, there's this push to protect the consumer. So you have PPI that has exploded, but you haven't seen that get passed down to the same level. And a lot of governments have maintained their subsidies. And a lot of the things that we've been seeing and talking about is those subsidies are getting very, very expensive. And as we also showed in segment one, the cost of doing business, the interest expense is going up. A lot of these countries had issued a significant amount of debt to try to stimulate their economies as things were were struggling during that different period. So now as we come to the other side of it, now you start to get some of these different pressure points and some of the issues that we're seeing. And it's going to be difficult to not pass through some of this pain, and why we're going to see some of these factory gate prices moving down and really hitting the consumer, because those subsidies are just too expensive. And we're going to see that get cut. Now, India and some other nations, but India most recently did it where they cut different tariffs for vegetable oils coming in. They've cut different fees for imports and exports to try to, again, reduce these prices to try to, again, pass on some of those savings to the consumer and try to cap some of that inflation that has really started to run rampant. Now, when we start looking towards the Chinese markets and where things are, because I think we've seen some of the different commentary, and I just wanted to give a quick level of summary of what the rumors are coming out of China, and we're going to go deeper into that. So the market rumors right now, so they're going to subsidize basic commodities, which makes sense given where prices are and how there's just such low inventory. They're going to try to cap that to try to slow factory gate prices and just, again, it's still stimulus though. So they're still going to subsidize it with someone's money. Whose money is it going to be? And that's why we do see the CCP budget deficit getting much worse. And the problem is the deficit has continued to expand, which if you look at the leverage at the CCP level, at the Chinese government level, that is going to become a growing concern. Raise standards for low-income groups. Again, they've been talking about raising standards for a very long time. Dual circulation strategy, common prosperity. It's a lot of it in name, but very little of it in practice. Invest in new infrastructure, new energy. Again, they've been investing in infrastructure, and they put that in that nice little caveat that we've talked about of, well, it has to be good investments in terms of cover principal and interest, which, as we know, the most recent ones have not. Invest 3.45 trillion yuan of government special purpose bonds. So we've seen that. So this is the special purpose bonds and the issuance that have gone up, and boost quotas of special loans and double quota of SME loans. So you've seen that, and the small medium enterprise size is the key one, but none of that is new. They keep talking about it, but the problem is the availability of credit isn't the issue, it's the demand for credit. How do you make the company want that loan? Because we've seen the availability there, but companies are so levered already. Governments are so levered already. They're not looking to take on fresh capital, especially when you look at on the government side, their revenue streams have continued to get cut from tariffs, VAT taxes, transportation costs, and then real estate. Real estate funding was a big piece of how they got some of this money. So here you can see the special purpose bonds, the net issuance it remains elevated. This is what they've been trying to do in terms of front loading some of this capacity, but they've kept the SPE loans, bonds, at the same as 2021. So the view is to keep the same issuance as of 2021, but try to pull some of it forward. Now, this new commentary could be that they're going to increase it and allow for an additional, but the problem is, what are you investing in? What do you want these projects, these local governments to invest in? A lot of the local governments have said there's nothing left. We've invested in anything that we could and then some, and then the piece that falls under the and then some is deeply underwater and not even covering principal, let alone interest. So that's where we're going to get some of these different problems. But the China housing demand structural headwinds. So when you start looking at just the working age population, which is continuing to fall, and the residential floor space that you need. So you have an underlying population problem, which is going to shrink the demand for how much residential flooring do you need. So you have a problem just now on a structural level. Again, this will take time to play out. But here's where the current downward pressure in the economy continues to increase and where they're going to try to offset it. So the tax rebates that we've talked about will increase from renminbi 140 billion, lifting the full year total to 2.64 trillion. The range of companies exempt from Social Security contributions will increase, bringing an additional 320 billion renminbi. Airlines will receive an additional 150 billion in emergency loans and get support to issue $200 billion worth of bonds. The State Council is also worried that foreign firms are getting impatient, as you've seen a huge outflow of capital. They promised to make it easier for employees of foreign companies to travel to China. Domestic and international passenger flights will also increase. There's also support for local governments are instructed to increase relief for small firms, rent, gas, water, and electricity payments. So again, more stress on their balance sheets, trying to pass that through, trying to capture some of those different pieces. So then when we take that to the next level and we look at, okay, well, there's more support, subsidies for SMEs that employ university graduate will increase, restrictions on car purchases will be eased, and that's something that they've done before, and the restriction on car purchases in terms of new cars, and then the common theme, most of them being measures are being ramped up. These are sensible, but they're not going to deliver that 5.5% growth. And that's the biggest target that they're trying to hit, that they're trying to go through, and they're increasing confident real stimulus is just over. There's still going to be something to come, but the housing market and the real estate market continues to be some of those bigger issues. So then when you start looking at what is out there, when we start looking at the manufacturing side, so now when we start looking at the service sector, it's contracted at the fastest rate for over 2 years. So when you look at the manufacturing services side, there's been that huge softness. But look at it coming into 2020. When you look at where we were, manufacturers continue to lay off people. So you have jobs coming off, which means you have people that are unemployed, which means that governments will have to pay unemployment, not getting tax receipts. A lot of these underlying problems of, okay, you're going to stimulate, but with what money, what borrowing? And there's, I think, the big piece to it. So China's farmers just got a subsidy surprise. So the Ministry of Finance announced the instruction of it had allocated an additional 10 billion one-time subsidy to farmers. So one of the big pieces that we're looking at this point is trying to get those farming side, trying to bring in farming as well. And it's because farming is such a huge part and they're so short, which is why they've issued those new deals with Brazil, why they're trying to solidify next year's crops, next year's fertilizers. So blunting the impact of inflation on agriculture imports, fertilizer, pesticide, and fuel for farm machinery, and making farmers more enthusiastic to grow grains. In early May, videos emerged showing farmers cutting down their green wheat fields for hay and silage for dairy cattle, which offered a faster path to growth and profits. And then by our count, this marks the third one-time subsidy in the past 13 months. Again, law of diminishing returns. So you keep giving these one-time hits, but you have to increase the size, otherwise you're not increasing the impact. Top leadership wants to avoid codifying a big new subsidy program for grain farmers to prevent scrutiny from World Trade Organizations. But again, upward pressure on domestic farm costs are here to stay this year, and global ag commodity prices are high and rising, which again is going to continue to create some of these impacts. So how do you buffer that? So there's just going to be more subsidies that are going to be needed, but more and more subsidies are going to be difficult to maintain, which is why when we start looking at the 5-year cut. So Chinese banks lower 5-year loan prime rates by a record since 2019. But look at where we go back to 2019. They've never been increased. They've only come down. And now, so is the U.S. I'm not saying that what they're doing is any better or any different than the U.S. I'm just highlighting the problem of what is the impact? What is as the diminishing returns increase, what are we trying to get? So the 5 years, they're trying to get that long-term loans. They're trying to get that long-term piece in there. But when you start looking at, again, the 1-year side, the medium-term outlook, when you look at the 7-day, all of that remains fixed, and people have been expecting them to cut rates, and they're just not doing it. They're not really coming in to do that at that level. So now when you start looking at the different statements, so guide financing institutes to spare no effort to increase loan issuance, just how much of an increase. And so in a separate statement, they've been trying to say they've been the PBOC and the CBIRC, which again is the monitoring of the banks, meeting with 24 major financial institutions to increase moderate credit growth. That's the goal. But they need to cut rates further because the supply is there, rates are still too high. But what then does that expose the banks to? And given the leverage ratios at the bank level, how much risk are they going to open themselves up to? So now when you start looking at major financial institutions should assume responsibility for mobilizing all their strength to meet credit demand. There is no demand. So what that's the underlying problem. So they want to increase, the PBOC said banks should increase financial support for small and medium-sized firms, not surprising, green projects, tech innovations, energy projects, water conservation. Water conservation and that food side continue to crop up, continue to show the underlying backdrop of what we continue to see in general. So with the economy so weak, fewer firms want to borrow, hence the disappointing loan data. The PBOC's statements come at a day after the State Council said that it wants banks to make large, long-term loans to fund public works. Well, they've been doing that for 20 years now, and yet they still have this huge problem. And the PBOC is essentially laying the groundwork to ensure banks are ready to lend when local authorities start ramping up infrastructure construction. But again, it's going to be difficult to see returns on that money. So now when you start putting it all together in terms of the pressure, the Chinese economic growth plunged as a result of the impact of COVID. But construction starts never got back above positive. Property sales have been waffling back and forth. Retail sales have been fairly flat since 2021. And then when you look at a lot of this foreign investment, you're starting to see these downward moves. So exports have come down. You're seeing, as we talked about in segment 1, that movement towards onshoring, nearshoring, all of these shifts away from China, because that is a specific thing against China. That is where the exports are going to come under pressure. So China needs to find other ways to generate growth, which is why you start looking at some of the other problems. The State Council decided to slash auto purchase tax by that 60 billion renminbi. And it's the last time they've done that, they were able to get a nice pop. But again, you're cutting taxes. You're cutting government receipts. And you've already been cutting government receipts. So what is that going to do for the underlying subsidies that you keep talking about? And that's where you start looking at the balance sheet and you're like, that math doesn't quite add up, but okay. And again, they could issue debt. I'm not saying they can't issue new debt, but at what rate? And at what rate would you be willing to lend to China for? Is it 5%? Is it 6-7%? And that's where you start to get a lot of these compounding issues. So then when you look at the adjusted total social financing as a percent of GDP, it's coming down again. And the activity indicator is coming down with it. And that's the underlying problem of the debt data is just not really showing up. And you're seeing a lot of it is in households. People don't want to take on more debt because they're already leveraged to the gills and they're not looking to take on much more, where non-financial corporations took on more debt and they're just kind of sitting there and you look at this and you're like, well, they've already increased debt. How much more do you want them to borrow? Which is why we've been saying it's like there's been a ton of debt available, but the demand has been lackluster. So then as you take that and look at some of these pivots, the record high youth unemployment. So unemployment rates for 16 to 24-year-olds continue to go up, and you're seeing it creep higher everywhere. But this is some of that fundamental functional problems in terms of trying to drum up support, in terms of trying to keep these people active. And this is where you have some of this fundamental problems when you look at the unemployment factors, when you look at spending and just what is going to be available for these individuals as, again, the population continues to age. The 5-year loan prime rate was lowered from 4.6% to 4.45%. The reduction in the rate, which is set by the Committee of Banks published, will directly reduce the borrowing costs on outstanding mortgages across the country. So again, trying to go after that mortgage side. A cut was widely anticipated, so it's nothing crazy, but the 15 basis point reduction exceeded expectations and was the most since the country's rate system was reformed in 2019. The move marks the strongest signal in action to support the property sector in recent years. President Xi Jinping, who is this year bidding for an unprecedented third term, again, trying to keep things going through, and they are looking to protect obviously the economy and real estate. Zero COVID approach limited case numbers significantly for much of the past 2 years, but over recent months has struggled to stamp out outbreaks. Obviously, Omicron, very contagious, has led to the closures of Shanghai for nearly 2 months, and now there's more concerns about it hitting Beijing. So again, more issues in terms of growth. And then when you start looking at the China PPI, so when you start looking at core CPI, trim mean CPI, you're seeing some of this flatlining, but PPI was missed estimates where it still came down, but it didn't come down as much as expected. And that's where the government is getting frustrated with the ability to bring down factory gate prices, which is why the subsidies are coming into, well, how do we bump up subsidies? How do we protect these people? And that's where we're getting some of these underlying problems. And again, the core CPI trim mean is not, they're going to try to protect consumers, but that's where we see that stickiness because the companies can't continue to eat these margins. They're getting some additional subsidies, but some of this will have to get passed to local consumers, especially as exports slow. So then property sales recovery stopped when lockdown started. So the goal is to try to prime the pump to accelerate it as people come out of lockdowns. But with people unwilling or not really wanting new debt, it's going to be difficult to get that to really shift. Where when you look at property sales continuing to be in Shenzhen, Guangzhou, and Foshan, you can see that the property sales have been fairly flat throughout this period, even as you have a fluctuation in COVID lockdowns. And it's really showing that there's not a huge impetus for people to go out and spend and buy. China's home sales declined faster in April under COVID lockdowns, but even before COVID lockdowns. And that's where where were we pre-pandemic? And you're seeing that there was this fairly steady move, but mortgages continued to come down and they actually went negative. And we're not seeing that adjust given the pressure that the consumer is under as unemployment goes up, as pressure continues to mount on what their living costs are. And then the developers can't get cash. So when you look at developer financing has slumped amid the deleveraging campaign, which is something that they want to arrest, but do they really want to re-lever some of these entities or just try to stop the bleeding? And this is something where I'm going to say they want to stop the bleeding. So you'll see support, but you're not going to see a growth. And that's going to be some of those different shifts in terms of those loans because they want some of the natural unwind in terms of the over-levered capacity. And then the repayment pressure will continue after a brief pause in May, because May was the lowest amount of debt that had to be repaid. And then that picks back up as we go through the summer months, which again is going to put a renewed risk on where is there going to be a pressure, how is this going to continue to move through the system, and how is that going to expand. Now, local governments will likely push for more supportive policies to boost land sales. Now, the reason why is because they're being told to lend more, but the largest revenue growth for them was from land sales. So you want me to stimulate more, but I still can't get my largest revenue driver. Plus, you're cutting the other revenue that I was earning, again, exacerbating the issues. So then China's trade share of GDP has fallen sharply since 2006. And this is where you continue to see that pivot as merchandise imports plus exports as a percent of GDP. China continues to see that slow. And it's a law of large numbers, as well as other people and countries are trying to pivot away from China. Foreign ownership, which just shows just the amount of capital flight continue to accelerate, again, creating some more concern and ways that they're trying to preserve some of this international capital. Property slump, home sales fell from mid-2021 and lockdowns worsened with weak demand. And again, you're seeing this continue to be pervasive. And you saw it start in 2019 and something that has continued as you see, again, a saturated market, over-levered market is going to struggle. China new home prices were negative again, coming at negative 0.3%. Which is another negative time, with China new home prices year over year is now negative. So before, new home prices were coming down month over month, but now year over year, you're firmly negative, which means that the collateral is going to be discounted, which means that you need more collateral, which again, just exasperating the underlying issues. And when you want banks to issue more debt, but the collateral on the current stuff is falling, you start to get some of this back and forth, which becomes a problem. Taiwan export orders had a big drop, which again is that leading indicator in some of those problems. And the two leading indicators are typically Taiwan and South Korea. South Korea, on the other hand, had a nice increase. Even again, on a dollar basis, volume basis, it was essentially flat, which is still good. But in new orders coming from Taiwan is something to keep an eye on when you're looking at some of that international trade. Now, cracks in India's recovery are widening. Indicators show a determination in jobs, sentiment, and activity have been falling. Recent government measures to curb prices of essential goods helping to reverse the damage and keep growth growing. But again, there's still so many negative movements and headwinds coming that we don't think it'll be enough. Broad-based slowdown in real activity for the week ended May 22nd, and we don't see that stopping. Measures of job and consumer sentiment edged down, while retail and recreation activity also fell. Again, seeing some of that, those cracks continuing to widen that we've been talking about. Core inflation rose across the core areas across the India. Core CPI ex food, petrol, diesel, everything. Core CPI of food, fuel, petrol, diesel, gold, everything is just up and out, which again is keeping a lot of those pressure on the Indian governments and why we remain bearish on the Indian outlook in the near term. And then when you start looking at wholesale price index for April, the expectations were for 14.9%, came in at 15.1. Again, back to the highs, continuing to see the wholesale price. And this is just that leading indicator for more inflationary pressures. Japan, now that the Japan core CPI accelerated after the telecom price declines fell out of the year-over-year data. So now we're back into positive territory. And the problem is Japanese PPI is over 10% for the first time in 40 years. So as PPI goes up, again, PPI, leading indicator for CPI, that inflation is going to continue to get worse. All the while, industrial activity has set that new normal in Japan where it is stabilized, but again, it not gotten back to that growth. Even though we've had manufacturing PMI getting a bit better, composite PMI getting a bit better, but it's also showing in terms of input prices. It's getting better, but input prices broke out to a new record of 63.3 on the service side. And then output prices, again, a new record at 55.5. All of that inflationary pressure on the Japanese front. Even now you have inflation going up. All the while, new export orders are now firmly negative again for the third time in a row, showing that leading indicator as delivery times continue to get worse, given all of the issues that we've seen along the supply chain. So there's a lot of issues in Asia. There's a lot of concern that we have. India is not a place that we're bullish right now. I think China will likely get a little bit of a pop because of the commentary that we've seen. But again, the problems still remain pervasive. So that's what we have for you today. If you have any questions, you can find us in the comments section. Otherwise, you can reach me on Twitter, and we hope you have a great day. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.